The Fed just blinked, and Wall Street is watching every move. Despite inflation cooling and unemployment ticking up, the Federal Reserve has refused to cut rates. Why is that? What are they afraid of? And how likely are rate cuts before the end of 2025? Let's break it down. Why did the Fed hold rates steady? The current federal funds rate sits at a two-decade high, between 5.25% and 5.5%. And after multiple meetings in 2025 with no movement, the Fed once again held firm in their most recent decision. Here's why. 1. Sticky services. Inflation. While goods prices have normalized, core services like rent, healthcare, and insurance are still running hot. The Fed's preferred gauge, core PCE, is above 2.8%, well over the target. 2. Financial conditions. Easing too fast. Even with high rates, equity markets rallied, credit spreads tightened, and lending activity picked up. The Fed is watching these signals and thinking, maybe financial conditions aren't as tight as they look on paper. 3. Labor market is cooling, but not collapsing. Unemployment has risen slightly to 4.2%, but wage growth is still running at 3.5% to 4%. The Fed sees this as a balanced slowdown, not yet requiring aggressive rate cuts. 4. Global volatility. With geopolitical instability in the Middle East and softening data from China and Europe, the Fed wants to stay flexible. Cutting rates now could limit their options if a shock hits later this year. What the Fed is signaling without saying it. Jay Powell has used carefully chosen language. We are prepared to respond to evolving economic conditions, but we need greater confidence that inflation is sustainably moving toward 2%. That's code for, we're close, but not there yet. We want to cut, but only once we're sure we won't have to reverse course. The Fed is trying to engineer a soft landing, lower inflation without a painful recession. If they cut too early, inflation could reignite. If they wait too long, they risk over-tightening. So, will we get rate cuts in 2025? Yes, but it's complicated. Base case scenario, most likely, 1 to 2 cuts in Q4 2025, likely 25 basis points each. Total cuts by year end, 50 basis points. Fed funds rate ends the year around 5.0%. Why? Because inflation is trending down, but not fast enough to warrant a full pivot. The Fed wants to test the brakes slowly. Think of it like tapping the pedal, not slamming on the gas. Alternative scenario, less likely. A sharper economic slowdown, say unemployment spikes above 5%, or a major credit event occurs. In this case, the Fed could cut 3 to 4 times, bringing the rate closer to 4.25% to 4.5%. But this would require real economic pain, and the Fed would see that as failure of the soft landing. Tail risk scenario, unlikely but possible. Inflation flares up again due to energy prices, wage pressures, or supply shocks. No cuts at all, or even a surprise hike. This is the nightmare scenario for markets and would crash equities and consumer confidence. What to watch for? Want to predict the Fed's next move? Focus on 1. Core PCE trends. Monthly readings below 0.2% suggest cooling inflation and support future cuts. Second, labor market reports. If jobless claims rise or wage growth slows below 3%, the Fed will feel more comfortable cutting. 3. Consumer spending. A noticeable slowdown in retail sales or credit card delinquencies could force the Fed to act. 4th, global events. Oil price shocks, debt crises, or geopolitical escalations could delay cuts or accelerate them. Final thoughts. The Fed is walking a tightrope, tight enough to keep inflation down, loose enough to avoid collapse. Rate cuts are coming, but don't expect a flood, expect a drip. For investors, that means stay cautious on high-duration assets. Be selective with growth stocks. And remember, the Fed may ease, but they're in no rush. The era of easy money is over. But the next chapter is just beginning. Like and subscribe to stay updated on macroeconomic trends, Fed decisions, and what's coming next in the financial markets.